This is TechCrunch. Silicon Valley tends to tolerate a certain amount of founder exaggeration when pitching investors, often dismissing it as part of selling a vision. But some choices cross the line and can lead to jail time for founders and scandal for their investors. Now, a case in point is Joseph Sanberg, whose once high-flying fintech startup Aspiration Partners was backed by a roster of tech celebrities, including former Microsoft CEO and current LA Clippers owner Steve Ballmer. In August of last year, Sanberg pleaded guilty to 2 counts of wire fraud and defrauding multiple investors and lenders. Each count carries a maximum sentence of 20 years in prison. Ahead of sentencing, which is scheduled for Monday, victims were invited to describe their experience with Sanberg to the judge. Ballmer did so, and publicly. Ballmer's lawyers said in the letter that he has lost money, been vilified, and that the NBA is investigating allegations stemming from the association. Sanberg co-founded green fintech startup Aspiration Partners, which offered what it called sustainable banking services like credit cards and investment products that avoided fossil fuels. The startup promised to automatically plant trees with every card purchase. In 2021, it announced plans to go public via a SPAC merger at a value of $2.3 billion, though that transaction never took place. The DOJ alleged that Aspiration booked and recognized revenue from entities held by Sanberg, who made the company appear as if it had a steady stream of customers and revenue that it did not actually have. The agency further alleged he defrauded investors by showing them a fabricated letter from Aspiration's audit committee that said the company had $250 million in available cash and equivalents when it had less than $1 million. The DOJ alleged that Sanberg, along with a board member who also pleaded guilty, falsified financial records to obtain $145 million in loans. When Ballmer shared his letter on X, asking the judge to consider the harm done to him in sentencing, he wrote, "I was duped and feel silly about that. Everyone who believed in Aspiration, including employees, customers, and investors, was also duped. Everyone is still tallying the losses." The letter says that Ballmer invested a total of $60 million in the company and lost all of it. Ballmer was not only an investor, but had contracted with Aspiration to provide carbon offsetting programs for the Clippers and its stadium. Aspiration also became a major Clippers sponsor. The billionaire said in the letter that not only did he lose that money, his reputation was negatively affected. He used the letter to deny the reporting of a multi-part series from famed sports podcast Pablo Torre Finds Out that delved into the relationship between the LA Clippers and Aspiration. The podcast made allegations that Aspiration helped sidestep the salary cap for a star Clippers player. Ballmer's lawyers called those allegations misapprehension or intentional disregard of the facts in the letter. Now, Ballmer's letter also said that as a result of the association with this company, the podcast and other public attention of it, he's been named in lawsuits. Meanwhile, the NBA said in its own letter regarding Sanberg's sentencing that it's investigating the salary cap allegations and Sanberg has been providing evidence. While the basketball world is embroiled in all of these downstream developments, the message founders can take from it is clear. If one fabricates financial documents to raise capital, the outcome will very likely be prison. The Ballmer Group did not respond to TechCrunch's request for comment. Palantir has helped the Internal Revenue Service's Criminal Investigations Office probe a variety of financial crimes in the U.S. for much of the last decade. That's according to reporting by The Intercept. Citing public records detailing Palantir's IRS contract that were obtained by the nonprofit watchdog group American Oversight, The Intercept reported that the IRS has paid the firm $130 million since 2018 to use its data analysis software to pore over financial records for investigative purposes. It was previously known the IRS was using Palantir's products and that the agency seized the software as a way to automate and modernize audits. Last summer, it was also reported that Palantir was assisting DOGE, the government efficiency initiative launched by President Trump's executive order, with a project designed to access IRS records. However, the extent of the agency's use of the company's tools had not been previously reported. The software, Palantir's lead-in-case analytics platform, is being used to aggregate and analyze data across a variety of federal agencies. The software can find connections from millions of records with thousands of links between various databases, and the tool is particularly good at mapping human relationships and communications. Last week, American Oversight sued the Trump administration for public records related to numerous federal agencies' use of Palantir tools, including the IRS. In a recent experiment, Anthropic created a classified marketplace where AI agents represented both buyers and sellers, striking real deals for real goods and real money. The company admitted this test, which it called Project Deal, was only a pilot experiment with a self-selected participant pool of 69 Anthropic employees who were given a budget of $100 to buy stuff from their coworkers. Nonetheless, Anthropic said it was struck by how well Project Deal worked, with 186 deals made, totaling more than $4,000 in value. The company said it actually ran 4 separate marketplaces with different models. One that was real, where everyone was represented by the company's most advanced model, and with deals actually honored after the experiment, and another 3 for study. Apparently, when users are represented by more advanced models, they get objectively better outcomes, according to Anthropic, but users did not seem to notice the disparity, raising the possibility of agent quality gaps where people on the losing end might not realize they are worse off. Also, the initial instructions given to the agents did not appear to affect sale likelihood or the negotiated prices. That's all for now. For more stories like these, go to TechCrunch.com.